What went down on Thanksgiving night in the silver market is nothing short of explosive. And I'm not talking about a routine price spike or some holiday week anomaly. I'm talking about a full scale financial confrontation, a collision between JP Morgan and Middle Eastern central banks that has the potential to shake the foundations of the dollar system itself. Sounds extreme? Stick with me, because I'm going to walk you through every detail, and by the end, you'll understand exactly why this matters to every single person relying on the dollar to hold its value. Here's what actually happened that Friday after Thanksgiving, while most Americans were wandering through malls chasing Black Friday deals. Out of nowhere, the Comex silver exchange announced cooling system issues and abruptly halted trading. Let me be blunt, cooling systems don't fail at the exact second silver breaks new all-time highs. That's not random. That's not technical. That's calculated. According to trusted sources, several central banks attempted to take delivery of 40 to 45 million ounces of physical silver from JP Morgan. Yes, physical, not paper. That's around 7,500 futures contracts worth of real metal. And when JP Morgan realized they might actually have to deliver, they reportedly panicked. Instead of admitting they didn't have enough silver to meet the request, they allegedly pushed for a shutdown of the exchange because once physical delivery fails publicly, the whole paper scheme unravels. And here's why this matters. Because silver is no longer functioning merely as an industrial input. It is re-emerging as money, real money, the kind that can't be printed, diluted, or fabricated on a balance sheet. Look at the signs. Russia just became the first major nation to officially add silver to its state reserves, allocating $535 million over 3 years to build a sovereign stack. Saudi Arabia's central bank is quietly loading up on silver ETFs. India has accumulated an astonishing 600 to 800 million ounces in the past 5 years. These nations aren't guessing. They see where the monetary winds are blowing. And then there's JP Morgan sitting on more physical silver than the Hunt brothers ever held at their 1980 peak, over 250 million ounces. But at the same time, they're also managing the largest short position in the silver futures market. Think about that for a moment. They're hoarding the physical metal while simultaneously betting against it with paper contracts. It's genius. It's reckless. And it has the potential to detonate the entire system if they get trapped. To understand the stakes, remember the Hunt brothers. In 1979, silver traded around $6. By January 18th, 1980, it rocketed to $49.45, a 713% surge in a single year. The Hunts controlled roughly 100 million ounces of physical and another 100 million through futures, essentially a third of the world's privately held supply. Then the government intervened. Comex changed the rules. The infamous Silver Rule 7 restricted buying but allowed selling, crushing the Hunts overnight. On Silver Thursday, March 27, 1980, silver collapsed from $21 to $10.80. The Hunts lost $1.7 billion and were wiped out. Now, compare that to today. JP Morgan has been stacking silver since 2011 when it last touched $50. They've methodically assembled the largest silver hoard in modern history without leverage and without fanfare. And the backdrop today is nothing like 1980. Back then, silver was largely a photography metal. Today, solar alone consumes 232 million ounces per year. Electric vehicles use 5 times more silver than standard cars. For the 5th straight year, the Silver Institute expects a supply deficit 149 million ounces short this year. Comex registered silver has collapsed to just 47 million ounces available for delivery. London vaults are down to 827 million ounces, most of which supposedly backs ETFs that couldn't deliver even a fraction of it if everyone requested redemption at once. Physical shortage is a hidden story. Lease rates, essentially the interest rate to borrow physical silver, recently spiked above 30%. That only happens when metal is scarce. And behind this shortage is the real driver, the unraveling of the dollar system. United States fiscal situation is catastrophic. The US ran a $1.8 trillion deficit in fiscal 2025 and now paying over $1 trillion annually just in interest on the debt, more than the spend on national defense. $11 billion every week is vaporized on interest payments alone. And the Treasury Secretary is trying to convince the world to buy US debt. That's not confidence, that's desperation. Other nations see it clearly. Asian companies now issue 23% of foreign bonds in euros, up from 17%, 86 billion euros worth, because euro borrowing is up to 25% cheaper after swaps. Every eurobond is one less dollar bond. China and Russia have moved almost all their bilateral trade, $240.8 billion in 2024, into yuan and rubles. India buys Russian oil in rupees. Brazil and China have swap agreements. China's CIPS system processed 170.5 trillion yuan in 2024, about $24.5 trillion, connecting to 4,900 banks in 150 countries. The world isn't repairing the dollar system, it's exiting it. And when fiat systems decay, history is clear. Money reverts to gold and silver. For centuries, the gold-silver ratio hovered between 12 to 1 and 15 to 1. Today, it's above 72 to 1, an absurd imbalance in a world with chronic physical shortages. JP Morgan knows this, so do the central banks. That's why Thanksgiving was a turning point. When a delivery request forced JP Morgan into a corner, the response allegedly wasn't to deliver, it was to shut down the market. Whether or not they admit it, that move told sovereign players everything. The paper silver market cannot withstand a physical audit. This is the same script we saw in 2011. Silver raced toward $50 and the banks pushed regulators to raise margin requirements 5 times in 8 days. Prices collapsed. But this time, the buyers aren't hedge funds, Reddit traders, or retail speculators. They're sovereign nations, entities that cannot be margin called, cannot be forced out, and do not disappear because the price dips. Meanwhile, physical premiums are screaming the truth. India is paying 15% above spot. China consistently trades silver above London. Shanghai deliveries are surging. Paul Tudor Jones, one of the greatest macro traders in history, is publicly buying silver and warning about currency devaluation. When billionaires start talking like survivalists, you should pay attention. So here's where this is heading. Eventually, a central bank, or a coalition of them, will request delivery that cannot be met. When that moment arrives, the entire paper silver structure collapses. Comex futures will decouple from physical prices. You'll see silver at $60 on the screen while dealers charge $90 or more. Price discovery breaks. Confidence evaporates. It's already happening. There's currently a $1 premium for Comex futures over London spot. A sign traders are scared they can't get metal in London. They're willing to overpay for even the chance of delivery at Comex. And the supply situation keeps deteriorating. Even with slight increases in mine output, declining ore grades mean we're pulling less metal at higher cost. Industrial demand is expected to hit 700 million ounces in 2025. Silver is also critical for national defense, missiles, radar, satellites. As geopolitical tensions rise, countries will not rely on Western bullion banks to secure their supply. Russia understands this. So does India. So does China. All of this has created the perfect storm. Central bank buying, industrial pressure, physical scarcity, declining trust in the dollar, all converging at once. JP Morgan is caught playing both sides with enormous physical holdings and an even larger paper short. If silver spikes to $80 or $100, they may make billions on the metal but lose multiples on the shorts, unless they can shake out weak hands and buy back paper cheaply. That's why the price gets hammered at 5:30 a.m. London time, why enormous paper dumps hit the market during thin liquidity. It's psychological warfare meant to terrify investors, but it's failing. Every dip is bought, every slam is absorbed. Physical buyers don't care about paper price games anymore. The writing is on the wall, the dollar system is weakening, nations are shifting to real assets, and silver, with both monetary history and irreplaceable industrial demand, is emerging as a centerpiece of the transition. When the dam breaks, the repricing will be violent, bigger than 1980, bigger than 2011. This isn't just a market cycle, it's a monetary regime change. The Thanksgiving showdown was merely the opening act. The real battle, the one that determines the next global financial order, is still ahead. As for what to do, I can't give financial advice, but I will tell you plainly what I'm doing. I'm stacking physical silver, not ETFs, not futures, real metal. Because when the paper structure fails, only the physical will matter. JP Morgan knows. Central banks know. The question is whether the public figures it out before the supply disappears. The signs are flashing everywhere. Shortages, premiums, central bank accumulation, manipulation, the dollar's decay, all pointing to one outcome. The age of paper promises is ending, and the age of real assets, especially silver, is beginning. This is the smart wealth code. Your compounding machine